Hello, everyone, and welcome to the video series where we're now going to actualize our understanding of CMHC. So, in the previous videos, we covered CMHC's standard program, CMHC's MLI Select program, and now we're going to compare in actuality the numbers of what it looks like for a 12-plex in London, Ontario, comparing financing between the bank financing, CMHC standard financing, and MLI Select financing, and how that all plays into the numbers. And we're just going to dive right into it. So this is a workbook that I've created utilizing the underlying information and underwriting that CMHC does, and included in addition numbers as it relates to bank financing. So over here, I've entered in that this is another acquisition we have under Foundation Capital Private Real Estate Trust. So it is a 12-unit building that we are buying at $2,650,000, which includes about 4 units per unit, which is a fridge, stove, and washer dryer. It is a wood-framed building. It does include AC. It does have a heat pump, and no, it is not going under MLI. So I just switched that, and no, it does not have an elevator. So with this workbook, you can switch a lot of different things. Basically, the greens is kind of where you input stuff, and I already input a lot of this information just so we could highlight and cover it. So as it goes into the monthly income, this straight comes from the appraisal or from the rent roll that you get from the seller that you're looking to acquire property from. So you just plug that in, the monthly rents, and it just calculates what you have on an annual basis. The vacancy allowance is per CMHC, so you can go on the CMHC website. As you see here, I've pulled it from the rental markets report for the region. So specifically for London, Ontario, they had 2.9%. Which calculates what the monthly amount would be and what it translates to an annual allowance across all 3 properties. And this is standard, and this is how you get to your effective gross income. So it's your gross rents less your vacancies. You add any chargebacks and laundry income. In this building, we've closed off laundry, it's closed off laundry, and it's in suite. So there is only rent income less chargebacks. So the property taxes are what they are. You can't really adjust anything. Building insurance. So whenever you're doing an acquisition, what we do is we reach out to our insurance provider. We tell them the details of the building, and they give us an underwritten quote. So we kind of know what the cost is. Depending, the seller might have higher insurance. I've noticed this quite a bit. Typically, they've stayed with the same insurance provider. So you just plug that in there. Utilities. This is the actual number. However, we use a frame of reference as we're going across new acquisitions. Sometimes people really sandbag utilities and say the tenants pay them. And if it's typically a lower paying tenant, we're going to turn it over. We add in additional expenses because we know typically we are seeing roughly anywhere between $1,500 to $2,000 in utilities per tenant once we put in-suite laundry in place and they're using it for themselves and it's a higher paying tenant. So yes, sometimes it will be lower, but over time they'll trend. So you just have to factor that in when you're looking to do your acquisition, and that's what we kind of do. And then this is, again, a quote that you get from your contractors. For us, based on our experience, we know between landscaping, snow removal, and cleaning of the building, it'll roughly be about $400 a month, $4,800 a year. That just happened to be also an appraisal, so it worked out well. And then when it comes down to what these are all auto-calculated. These are percentages that are used by the banks. So I have a contact that I work with at BMO who finances our deals, and they're able to advise and tell me kind of what percentage that they utilize for management and salaries. So you might be wondering, what's the difference between management and salaries? Well, management and salaries comes down to people who are physically on the ground working at the building. Sometimes that's a site super, and this is something that CMHC automatically factors in as somebody being at the building. Again, it's kind of shitty because in some of our stuff, we don't really have an on-site super. Everything is kind of remotely managed. And typically our management costs spread across all the buildings is a lot lower. But this is what they do when they look to underwrite your calculation. So CMHC doesn't necessarily use your appraisal value. They determine their own value. And so that's what we're doing here. And the bank does the same thing. So we're basically calculating how the bank gets to its value, and we're going to see how these loans all compare next to one another. So you'll see the bank is lower by almost half on management. They're about 2/3 as it comes down to salary, and then on repairs are roughly in line. Again, some of this changes depending on like if it's wood frame or concrete. You're wondering how salary changes. I guess they expect you to be in the building more. These are all based on CMHC guidelines. You got to speak with your mortgage broker or get access to the CMHC reports to be able to determine this information. As we are constantly in the industry, we are aware what happens when it comes down to wood frames or concrete. So that's what it comes down to. And then maintenance is also based on wood frame or concrete. And, again, this auto calculates at times to what you're going to get based on what it is. So in this case, because it is wood frame, it is a 30 unit versus being 975. This miscellaneous expense is something CMHC always puts in as part of their factor, and then they have like their reserves as well. And this is kind of how a lot of these expenses calculate. A lot of these percentages are based on the effective gross income. As you can see here, it goes based on rents there. So really, when we're comparing apples to apples to apples, we're able to see that bank expenses are about 10K lower. And we can see that's because CMHC also buffers for having to repair or replace appliances, the heat pumps or AC. So in this case, because the building does have AC, but there's no heat pumps, this is what the cost is. When you do have heat pumps and things like that, it does go up higher. And the more appliances you give your tenants, the more expensive it is. In our case, we do provide in-suite laundries, so yes, we do have a higher expense, but that's typically translated to anywhere between $200 to $400 in additional monthly rent. So we're able to say, you know what, annually for the cost that exists, it's well more than worth it. We're going to be able to pull out more capital as a result. And so as a result, we're able to see that the bank financing versus CMHC financing has a variance when it comes down to net operating income. CMHC annual standard versus MLI, for the most part, as it comes to expenses, is roughly in line. There are stuff changing with the premiums and stuff like that right now due to additional achievements and whatnot. This does not take that into consideration. This is just based on where the program is as of today, which is July 22nd, 2025. And then it comes down to cap rates. So cap rates, you're wondering how you can determine them. Well, you can utilize a variety of reports. I've used information based on CBRE and what we've dealt with at CMHC to kind of come up with what does it cost for us for like cap rates from a low, average, and high range. And so we've determined it's anywhere between 4.5 to 5 with the bank. So, the bank would use like a 4.75, whereas CMHC in London, in this area specifically, would use about a 5. But, as more transactions sales happen in the market, it can range between 4.75 and 5.25. So this means based on bank financing, on the higher end, the valuation of the bank would value it as about close to about 2.7 million, or 2.672, which is higher than our appraisal value. And then on the low end, they'd be about 2.4. CMHC standard is 2.3, with the low value being 2.1, and that's the same across the two of them. And then it comes down to sort of where we're looking at interest rates. And so, this was based on what the effective, 5-year and 10-year yields were at the time of making this video. And so based on that, the bank rate was looking like 5.24 for the property, and for the 10 years and standard and MLI was about 4.51, 4.18 on the 5-year. So you're still going to pay your CMHC premiums. You're just going to have to renew it again and maybe potential to pull out more capital. But you're going to be paying broker fees and things like that. So typically when we're looking at a smaller delta spread between like the rates, we compare what the total debts are going to be versus the cost of having to renew the debt and say, you know what, maybe we're locking in a higher rate right now, but it has cost savings for our investors because we're locking in for an extra 5 years, able to get more turnovers and push rents up before we pull capital out. So when we look at all three of them, we know that MLI Select had the best DSCRs at 1.1. The bank's only going to do a 5-year term, so that's at 1.1 as well. Sometimes the bank will even go as low as 1. Talk to your banker if you have a good relationship. You've done a lot of deals with them. They can lower that. And then we do debt service for standards 1.2 and 1.3. So definitely the higher debt service coverage ratio there. And so now we got to determine what does that look like from a monthly basis. So we've basically factored in a variety of amounts. So as we can see here, for a monthly payment, we've come back with what the total debt service it could be for $1,000,000. So on $1,000,000, you're looking at about 5,515.84 on a monthly basis. You multiply that by 12, and then we say, okay, this is what the debt service factor is going to be when you multiply this by 1.2, and we back into that debt. So to go straightforward here, we're going to the bank financing scheduled payment. It plugs in the $1,000,000 at the 5.24. It says, okay, 5,515.84 is going to be what the monthly payment would be. So from there, we multiply that by 12 to know what the annual cost for $1,000,000 kind of is. And then for the debt service factor, we basically say, okay, this is what it costs to service $1,000,000. At 1.2 is 72,000. Now we take the 72,000 and we divide it by the net operating income to say this is what the maximum debt is. It's just a little bit of math. We've got this all automated, so it tells me the bank will finance me $1.651 million on this deal, and compared to the appraisal value, that's only a 62% loan to value. Same factors are being applied here for both the standard and MLI Select, and I'm seeing that yes, under CMHC, under the 5 years, it's a lot lower in comparison to loan to value, but on the 10 years, I'm getting a much higher loan to value. And again, that's because you have a longer amortization, the payment goes down. And we're able to see that, look, on the MLI Select basis, we're able to get 95% loan to value based on what CMHC has determined the value to be. But that's truly only 79% versus your appraisal value. So when you're seeing a lot of people putting out and saying like, oh my God, it's 95%, you only need 5% down, that's great. Depending on the market, sure, that can work, but most of the time, the value CMHC determines is going to have a haircut. And in this case, under MLI, we're seeing about a 16% haircut to the reality of saying maximum 95%, but really in comparison to the appraisal value, it's 16%. So you'd have to be ready to put at least 16% down, plus your CMHC premium and other broker fees and costs that are required. And then as we compare that under the standard, it comes down to 67% loan to value. So you're putting down about 33%, but that's about 81% of the asset costs there. And then we see what does each of the options entail. Well, even though right now it's looking like you're going to get about $300-ish more $1,000 with MLI, there are obviously the additional requirements from energy efficiency and renovations that you have to do, reporting, and all of that. On the low end, I put in about $30K in regards to like the reporting, audit, administration, because again, that takes time. You have to report to your lender. They might come back with questions. There's going to be walkthroughs. You have to coordinate contractors and staff, coordinate with tenants. It can be kind of annoying. So $30,000 is kind of a low end actual cost for just the administration and professional reports. And then this is the cost per MLI, which is calculates based on the number of units. This is just kind of based on what we typically see for different type of unit renovations that you'll have to do, whether it's improving with heat pumps, updating the lighting, upgrading HVAC controls, plumbing fixtures, and other miscellaneous envelopes and electrical stuff. And so we've said, that's roughly about 14.3K with some soft costs, about 20%. So that's related to like administration, anything that you might have to pay the tenants for inconveniences and stuff like that. So you're looking about 17K per unit. And that is on, let's call it lower end. If you had to do like window panes and some other stuff, that can add significant costs. So when we back all of that into it, we're seeing that we're looking at roughly, what you're truly going to net after you go MLI is about $1,867.22. Experience when you compare to bank financing of 200K. So you can say, all right, well, if you want that 200 extra K, you're not necessarily going to go bank financing. But then when we compare it between the two here, you're only getting 81K more out. And actually, when you go down further and we compare, these are the insurance premiums that are calculated based on the loan values and loan amounts. It's just 3.8%. And then again, this is being adjusted based on updated new CMHC terms. When we compare the difference, it costs about $12,000 more for the premium. And so net, you're going to be able to take out 70K more, or about 70K more, 69K more by using MLI Select to get that higher loan to value. But you've got to take into consideration for that 70K, you're going to have to renovate and upgrade every single unit. You're going to have to pay for inconveniences. We factored in 30K for kind of like paying tenants and managing that process, but it can be even more. So when you analyze it, you have to say, all right, depending on how much time this kind of work is going to take, and if you're already have high stable kind of tenants in the place, then it might not really be worthwhile for you to switch. And for us, when we did this analysis, we determined that, you know what, it makes more sense for us to spend the time trying to actually obtain vacancies in the building, turn over the last few remaining tenants, calling places, find them alternative housing, calling their support workers, finding them other place to live, getting them on other waiting lists, and looking to transfer them over, will basically allow us to bump the rent about $1,000 in one of the units, and that'll generate about $250,000 in value and allow us to take $200,000 out for our investors. So that's worth more of our time and can be done in a fraction of the time versus us spending and doing the upgrades. So as a result, yes, MLI does allow you to take out effectively $70,000 more, or $69,000 to $70,000 more versus the standard program. So it's definitely something to consider, but doesn't make it the holy grail and so amazing that everyone needs to be doing MLI. Obviously, the MLI program has other benefits, which is more from a socio standpoint, where the government wants you to be doing it because you're making the building more energy efficient. You might be able to realize some utility savings and drive the building value up higher. So again, when you're working with your professionals, if you can generate other value or be able to generate tenant turnover by doing some of this, then definitely looking to do MLI is the way to go. But again, there are reporting requirements. You're going to have to deal with the lender, provide that information. You're going to get audited, all that kind of good stuff. So, for me, I would say for 69, 70K of additional loan, it doesn't really make sense. It makes sense for us to probably hunt and find a better deal or a vacancy. Even giving tenants additional laundry when they don't have in-suite laundry and getting them come up $300 in rent monthly. That $100 in rent creates 25K in value. So $300 for one unit adding laundry or two units adding laundry at $200 a pop will get you more value than going through this energy efficiency process. All this does is help government hit its mandates. But also, we do look to do it if it makes sense, if we're going to be renovating a lot of this stuff. So you have to look at your construction plan, what your plan is for the building, and see if it makes sense. For us in this building, we are going the standard program. But when we compare the two as well, we also notice that at times going the bank financing route is sometimes better and easier, especially when you're looking to do a quick acquisition. Maybe you want to get a few more turnovers. What we do is we will acquire through bank financing or private financing. As you can see, it's only a 65K difference in regards to the loan amount. So you have to put a little bit more money down. You're only going to get like 2% loan to value versus the appraisal value. But you can spend 6 months trying to get there's about 4 tenants left in this building that can be turned over to generate higher rents. Turning over two more tenants will generate additional value takeout. So if we say here the net value takeout is $1,650,000, this is 1.7. If I were to say on the top line, I'm going to add an extra $2,000 by getting those turnovers, boom, the bank financing in itself will go to $1,952,000 and CMHC standard program will go to $2,050,000. So if we undo that change that we did there, we can see that $2,050,000 versus 1650, you can take out almost 400K. And versus standard program is about 300K. And sometimes you'll do that because you're going to get those turnovers, and then you can pull out capital for cheap and then redeploy into other projects. Again, with MLI Select, you might not necessarily be able to do that. You're going to have to make sure you finish doing all your energy efficiency upgrades before you're able to go get a pari passu second. With MLI Select, with standard program and MLI Select, you can have your existing in place. Once you get turnovers, you can go to the lender and look to take out more money. Typically, they will want to see at least like $1 million or a larger turnover amount for them to be worthwhile to issue a new mortgage and be able to do that whole process. Because again, a lot of the lenders don't necessarily carry the debt on their balance sheet. They are packaging our mortgages into a bond and selling that off. So for them to be worth it for them, and without us getting destroyed for fees, like you're looking at least like $1 million takeout for it to be worthwhile. So if we were to just acquire under MLI, we'd be kind of stuck there. With standard, we got a little bit more option. We could kind of break it. But under bank financing, that's where bank financing makes sense, where you can get these turnovers. You've assessed that during your walkthroughs of your buildings. And you're going to be able to bump those last few rents, then take out some capital as you go to CMHC. So this is kind of the analysis between the three options here. As we noted, between bank and standard, you're looking at about like net after the insurance premium, only about 65K, but between bank financing and MLI Select, you're looking at about 135K. So 65 to 135K more versus bank financing. Bank financing has a lot less fees, a lot less costs, all of that. You basically got to save these insurance premiums, but we factor that in as part of this cost. So definitely standard and MLI Select through CMHC allow you to take out a lot more money for your projects. But again, it's not the be all end all. It's not going to, if you're not getting turnover, if you're not pushing up your rents, or your rents are low, it's going to be hard to make it work. And during that time, you're going to have to see whether it's bank financing, standard, MLI, or sometimes you have to go private because if you're going based on off the net operating income as we are doing here, but based on what the future value of the turnovers can be. So as a high level from what we discussed, MLI Select is great. It's not necessarily the be all end all. Net, we're looking at $135,000 more versus bank financing. Between the two, it's only between standard and MLI, there's only $60,000 more, and between bank and standard, you're only looking at about another $60-something thousand as well. So MLI is great if you want to get your maximum top dollar out. However, some of the cons that we talked about it were that there's additional costs, administration, reporting, and your time could be better used elsewhere. So when you're looking at the CMHC options, sometimes going with the standard versus the MLI does make sense. So you can focus your time elsewhere and generate more returns for yourself and for us, for our investors. And then when you're comparing the two between bank financing and CMHC, if you're seeing there's potential capital to be taken out and a couple more turnovers before you want long-term stable financing, that's where bank financing can make sense. It's a lot cheaper to get into. Again, they're factoring a lot less expenses here. And, when we said, let's add that $2,000 up here, we saw that bank financing is still lower than CMHC, but you see that it gets still relatively close. So it's cheap, quick, easy, able to get cash out. You have a relationship with your bank. It might make sense. However, for us on this specific deal, we are going with CMHC standard. So hopefully you guys are able to see a real life practical example of this. I'm sure you have a ton of questions. I kind of went through this pretty quickly. If you have any questions, comment them in the video, reply to the email. Thank you so much for your support. Hopefully you got a good understanding of comparing the options between bank financing, CMHC standard, and MLI Select. Thank you so much, guys, and we'll see you soon.